Everyone, today we are going to study something about the non-farm payroll, how we can trade non-farm payroll effectively, and also how we can analyze the data and then use those data that we have analyzed to trade effectively. At the end of this discussion, you should be able to analyze the non-farm payroll report numbers, know how to analyze other big events too, and also have a simple strategy to trade in non-farm payroll, and then know the strategies also drawbacks. Since we know that nothing is perfect in this world, but one thing about this strategy is that this has almost about 85% winning rate. The NFP report reveals the U.S. employment situation, shedding light on the strength of the economy. It is released by the Bureau of Labor Statistics and every month, usually on the first Friday. The reason we use the word usually on the first Friday is because sometimes if the first Friday is on the first, it does not normally drop. They have to move to the second Friday. The non-farm payroll report causes one of the consistent and then the largest rate movement of any news announcement in the forex market, which makes it very significant for traders and other investors. They all wait for this particular news event, because with this news event, the market move aggressively with huge pips. It falls into your direction, it means you are going to make a lot of pips. So with this knowledge that we have, let us go to our forexfactory.com and then see how we can analyze those details over there. Remember, it is not only Forex Factory that gives the data or the news event. There are other sites also that gives also news event. You can either go on Google and use the Forex Factory, or you can have the Forex Factory app also and then use it to analyze the data. So this is the non-farm payroll. This is the non-farm payroll over here. All these red boxes here shows high impact news, or all these ones are high impact news. All these ones are high impact news, but we are going to use the non-farm payroll. And the same way we analyze the non-farm payroll, the same applies to all the other high impact news. So you tap on it and then you see the data below it. When you tap on the data, will come below it. And then you can see that we have the actual here, we have the forecast here, we have the previous also over here. Now we are going to compare the actual to the previous, because the actual just came in and then the previous was already data that was released the last time, and then the forecast is what those analysts over there predicted. Now what are the outcomes that we are looking over here? If the actual is better, we are looking at if the actual is better than the forecast, then it's good for the economy and the currency. If the actual is better, that means that it is good for the for the economy and then the currency. It means that the US dollar will rise, will move up, will rise, and the other currencies will fall. And also, if the actual two has no significant, the number two, the actual two has no significant, that is significant change. That means sometimes you could see that the previous data that was given was, let's say, 297k, but the current or the actual that was given today could be, let's say, 287k. You see, the impact is not all that much. It's not all that big. So you see that it can't have any significant change for the economy. So with this, it's a mixed reaction for the economy and the currency. And the third, what we are expecting also is when the actual is worse than the forecast. When the actual is worse than the forecast, that's bad for the economy, for the economy or the currency. That's what we can see here today. You see that today the actual is very, very, very bad or worse. It's very, very bad or worse, and worse for the economy and then the currency. So it means that today all the currency that the US dollar is associated with should rise, the US dollar should fall because it is worse over here. Let's see. So now let us see our strategy that we are going to use. We are going to pick any of the currency that is associated with US dollar. So we decide to use, we can use Euro USD, you can use Euro USD, US GBP USD, Australian USD, you can use New Zealand USD, you can use any of the currency that is associated with the US dollar. But we are going to use gold today, the gold USD, the gold US dollars. And that is what we have over here. That's what we have over here. That's what we have over here. Remember, as I said earlier on, the data is already given. It's already given. So this is a previous chart that we are going to use. So we could see that this was it was here. Yeah, I found it. Here was where the news was released. Set up your the 50 minutes chart. Take no action for the first 15 minutes after the NFP announcement. Wait for the next candle to form, the high and then the low of the current candle becomes the rate of triggers. Place a stop loss above and below the most recent high low with your stop loss. If your stop loss exceed 27 pips, don't take the trade. Exit with 1:2 ratio or 1:3 ratio reward, or greater than that. You can also exit after the 4 hours entry. After you enter the trade, after 4 hours, you can exit the trade. So let's see what they are talking over here. So with this side, the news came here at this particular level. So we will not do anything. We will wait for the next candle to form. So what was the next candle? It was this next candle that formed the pin bar over here that formed over here. Yes, that was the next candle that after the news release. This was the candle that formed. The pin candle over here is what formed. So we are going to put our marks. We are going to mark the highs of it. That's the highs of it is this one, and then the lows of it is at this level. The lows of it is at this level, and the highs of it is at this level. Please look at where the pointer is. Look at where the pointer is. At this level is the high. At this level is the high, and then the low is at this level too. The low is at this level, at the wick, where the wick is the end of the tip of the wick is the low, and the high is at the top of the body over here. Now that is what we are going to mark. So we could say that after that, the next candle of the news also went up. So it means buy. So we are going to buy. Why are we buying? Because the US dollar fell from the previous chart or from the previous news event. It fell. So we have to buy over here. So when we bought and we place our stop loss will be at the wick of this particular candle. The wick of this particular candle. Where we marked. That's where the stop loss will be. And we say it went all the way up, all the way up, all the way up. So when you get your 1:3 reward ratio or 1:2 reward ratio, you can close your trade and take your profit. Or you can also wait after 4 hours. After 4 hours, it went much. Here's it. The 4 hours ended over at this. I think over at this level. So yeah, you can take your this thing over there, your profits over there, and you are done. It's simple. Now let's look at the drawbacks of this strategy. You can experience strings of losses. Hence, greater reward risk ratio is very, 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 very good. Markets may move in one direction aggressively, and it may begin to fade by the time when the current candle started. It is also important to note that the high volatility times events after the waiting of the pattern also set up may also reverse. When there's a high volatility impact, it can also reverse, and you can hit a stop loss. This is very, very important for you to have a stop loss. So always make sure that you place your stop loss at this, so that when it reverses, it will not hit, or it will not take all your invested capital. Thank you, guys.